Japan is the world's third largest economy and potentially one of the most important countries predicting how the future might unfold in the next 10 years. Simon Kuznets, Nobel Prize winner in economics and namesake of the Kuznets curve, once remarked that there are four types of economies in the world: developed economies, underdeveloped economies, Argentina, and Japan. This was an ironic way of saying that these countries never really followed conventional wisdom on how national economies were supposed to operate. Now, Argentina is a completely different story. Japan was once the world's largest economy, and in the 80s, people thought it was almost inevitable that it would surpass the United States, fueled by massive exports and rapid domestic market development. This might sound familiar to many of you today. However, since its peak, the country has been stagnant with no real growth for 3 decades. To combat this stagnation, the Japanese government has been the first in the world to deploy unprecedented economic measures, which again might sound very familiar to some of you today: quantitative easing, negative interest rates, and consistent deficit spending. Unfortunately, none of this has really worked, pushing some of the world's leading economists to have some interesting and potentially very concerning discussions. So is there something unique about Japan's economy causing the stagnation? Or has the time finally come to admit that endless growth in a finite world is not sustainable for any economy? Finally, if Japan is truly at the forefront, what can we learn about economic stagnation, inflation, and government intervention from the country's experiences over the last 3 decades? Once all of this is done, we can place Japan, the world's third largest economy, in the National Economic Classification. Explaining the history of modern Japan's economy truly begins in the mid-80s. By then, the country had fully recovered from the effects of World War II and had become an economic powerhouse rivaling the United States, manufacturing everything from cheap and reliable cars to cutting-edge electronic products. This was made possible thanks to a new global push towards free trade that allowed this island nation with limited resources to focus on high-quality manufacturing while relying on other countries for raw materials, food, and anything else that was difficult for Japan to produce on its own. This is a textbook example of comparative advantage. Countries like the United States excel in agriculture but are not as good at manufacturing consumer electronics. Countries like Japan are great at manufacturing consumer electronics, but not very good at cultivating food. If both countries focus on what they do well and trade with each other, there would be more food and electronics for everyone. These were good times, and sustained double-digit growth meant that most Japanese citizens had seen a significant improvement in their quality of life throughout their working careers. But of course, this did not last forever. The United States began to worry about competition from countries like West Germany and Japan, especially the automotive industry, which was and still is a significant source of employment for all these nations. The normal solution would have been to impose trade restrictions, apply tariffs to all Japanese cars and video players arriving on US shores. Although far from being a solved problem, if the United States imposed trade restrictions on Japan, it is likely that Japan would return the favor, meaning US exporters would also lose out. It would also mean that US and Japanese citizens would fare worse off as they would be forced to buy more expensive products from artificially protected manufacturers shielded from global competition. So a kind of compromise had to be reached. What the countries devised was a plan to artificially lower the value of the US dollar relative to the currencies of West Germany, France, the United Kingdom, and Japan. This plan was signed by the 5 participating countries in 1980 at the Plaza Hotel in New York, hence its name, the Plaza Accord. If US dollars were worth less, US citizens would have less purchasing power for foreign products, and citizens of all these other countries would have more purchasing power when it came to US products. This way, US manufacturers would be more competitive globally and domestically. It's not a bad deal for Americans, but why would Japan, a country heavily dependent on exports, accept such a thing? Well, the first reason is that they didn't have many options. If Japan had not accepted the agreement, lobbying groups from US manufacturers would have forced the government to impose tariffs on Japanese imports. This would have been worse for Japanese companies than a simple currency exchange. It also would have been worse for Japan as a whole. Of course, they exported more to the United States than they imported, but the United States relied not only on their cheap cars and luxurious home entertainment systems. Japan, on the contrary, depended on the United States for food and many of the raw materials needed to manufacture all the products it exported. Firstly, for this reason, the Plaza Accord was primarily seen as a win-win. The United States achieved more competitive manufacturing, and Japan got everything cheaper. When the Japanese yen appreciated, the nation's citizens bought everything from American vacations to American companies. Japan had worked hard as an industrial workshop for 4 decades and had done well, but the Plaza Accord made it wealthy. In the span of 3 years, the relative value of Japanese money had more than doubled. By the late 80s, Tokyo was the world capital of hard work and hard play. Jordan Belfort's spending couldn't compare to what Japanese businessmen spent on their businesses. In 1989 alone, $50 billion, equivalent to $113 billion today, were charged to the expense accounts of Tokyo's companies. In addition to the unrestrained parties, this had very real repercussions on the economy. The value of real estate in city centers skyrocketed to unprecedented levels never seen since. If a $100 bill had been placed on the ground in Ginza at the end of the 1980s, the value of the land covering the bill would be higher than that of the bill itself. And again, this is in 1989 dollars. To add fuel to the fire, the Japanese central bank lowered all interest rates as a preventive measure to reduce the impact of the loss of exports. Instead of doing any of that, this cheaper money was mainly used to speculate in the stock market and real estate sector. In hindsight, it seems foolish, but many people sincerely believed that Tokyo was going to be the new center of the world. If some things had gone differently, maybe they wouldn't have been wrong. Unfortunately, as you already know, the boom of the 80s didn't last forever, but marked the beginning of a new era, the start of stagnation. The real estate and stock market crash in the early 90s put Japan in a very difficult situation. Its banks now face the risk of people defaulting on homes that were only worth a fraction of the mortgage price. The same problem also affected Japanese companies. People had just seen their net worth evaporate overnight, and in many cases they still had to face the overwhelming debts that had fueled their extravagances. The culture of consumption quickly shifted from unrestrained extravagance to modest frugality. As consumer demand decreased, so did prices. The reduction in the price level of goods and services is called deflation. It might seem positive, but most economists fear deflation more than inflation, and Japan was about to discover why. As prices dropped, companies earned less money selling their products. Less money from sales meant that companies had to defer salary increases or even cut staff, reducing household incomes. The reduction in household incomes meant that people had less money to buy things, reducing demand, which in turn lowered prices. It's a vicious circle that is very difficult to combat. To make matters worse, as the relative value of the yen increased, so did debts expressed in that currency. If you took out a loan of $1 million to buy a house and then deflation makes that $1 million worth twice as much as before, you'll have a really hard time paying it back. The Japanese central bank tried to combat this situation by lowering interest rates, but it had very little effect. Economists refer to the 1990s in Japan as the lost decade. But that doesn't mean the next 2 decades were better. By the 2000s, Japan had recovered somewhat from the debt hangover, but then faced new downward pressure from China. For a long time, Japan was the reference for low-cost mass production, a role that remained useful despite the Plaza Accord and the slowdown of the 1990s. But when China opened up to trade, Japan quickly realized it could no longer compete in price or quantity in international markets. Around the same time, Japan also began to realize that its young and productive population of the 80s was aging and retiring. This posed a burden for younger workers and social programs that had to take care of those who were no longer contributing to the economy. The aging population problem is not exclusive to Japan. Most advanced countries have a fertility rate below 2 children per woman, meaning their populations age over time. This is due to the fact that Japanese people live for a long time, but also because there has been a cultural hesitation to rely on immigration to rejuvenate the workforce, as is common in most other advanced economies. Throughout all this time, the Japanese central bank lowered interest rates again and again in an attempt to address these problems and kickstart the economy. Unfortunately, it had very little impact. In response to this, the central bank became increasingly desperate to try new strategies to stimulate the economy and get inflation on the right side of negative. The biggest hammer in their toolbox was quantitative easing, a a term we are all familiar with today, but was considered very radical when Japan first used it. Quantitative easing involves a central bank creating money and using it to buy assets in the open market. Normally, these are government bonds, but in Japan's case, the central bank went on to buy basically everything that came its way: government bonds, corporate bonds, and even stocks. Currently, the Bank of Japan is the largest holder of Japanese company stocks. The idea behind this plan is to put money directly into the hands of those selling these assets. If the bank buys government bonds, it gives money to the government to spend on building roads or social programs. If the bank buys corporate bonds, it gives money to companies to build new factories and offices. If the bank buys stocks, it could very well be giving money directly to ordinary consumers to spend in the economy. But why hasn't it worked? Despite low interest rates and strong quantitative expansion over the last 2 decades, Japan's inflation has remained stubbornly low, hovering around 0%. Some economists see this as something that should reassure us. If sustained low interest rates and quantitative easing didn't cause inflation in Japan, then it's unlikely to cause hyperinflation in our own economies. So is this a reasonable expectation, or is Japan special? There are some reasons to expect that Japan's situation is different from what is currently experienced worldwide. The first is the time frame. The United States has carried out strong quantitative easing over the past 2 years, not the last 3 decades. By spreading cash injections, participants in an economy have more time to react. Doubling the money supply in 20 years is not a big deal. Doubling it in 2 years might be. The second significant difference is the supply side of the economy. Apart from an aging population, there are no major differences between Japan's current productive capacity and that of 3 decades ago. If an economy has $5 and 5 loaves of bread, each of those loaves should cost $1. If suddenly that economy has 100 loaves of bread and $100, then each of those loaves should still cost $1. Of course, this doesn't take into account a series of factors like the elasticity of bread demand, competing products, and the general population's gluten tolerance. If the money supply increases, so does aggregate supply. There is no reason to expect prices to rise. On the contrary, supply has been severely affected in most countries worldwide. Waiting lists and empty supermarket shelves are things we are becoming increasingly familiar with. The third significant reason is something much harder for economists to grasp: Japan's professional and consumer culture. In Japan, asking for a salary increase is a taboo, and given that the working population is aging, it is also more challenging to get a promotion or change jobs for a better salary. This is because the corporate ladder is filled with people who have been in their companies for decades. This means that disposable incomes have remained almost entirely stagnant since the 90s. If we compare this situation with the United States, where workers are much more active in demanding raises, promotions, and new job opportunities, we will see that available personal income has increased spectacularly in the same period. A side note is that the irregular nature of this graph is due to Japan collecting its data quarterly, so they are subject to seasonal changes around holidays and bonus periods. On the flip side of the same coin, Japanese consumers are incredibly cost-conscious and demand stable prices. Japanese companies are known to issue formal apologies for raising their prices by just 10 yen, equivalent to about 10 cents. The same financial prudence extends to companies as well. When US companies receive a large injection of liquidity, the first thing they think about is how to reinvest it in the business. In contrast, Japanese companies have historically preferred to return that money to their investors. This must be really annoying for the Bank of Japan, given that it is the largest investor in these companies and works hard to provide them with liquidity. Ironically, the expectation of inflation can cause inflation. If people expect prices and wages to rise, they will accept higher prices at the supermarket and demand an increase every year. If that expectation doesn't exist, they will be upset about price hikes and will settle for stagnant wages. Japan's economy is infinitely complex, and there's a good reason it was one of the first countries I explored on this channel. It's also the reason why some of the world's best economists are completely baffled by how it behaves. We can learn a lot from Japan, and it's a great example that printing money doesn't necessarily lead to inflation, but we also have to respect its differences as much as we draw conclusions from its similarities. Now is the time to put Japan, the world's third largest economy, on the national economic scoreboard, starting as always with the size. Japan has a GDP of just over $5 trillion, which would be impressive on its own, but it's even more so considering it has maintained this impressive figure for almost 30 years. In any case, it gets a 9 out of 10. Its per capita income is also very strong at just over $40,000 per person. This makes it an advanced economy for sure, but it still lags behind places like the United States, Germany, and Australia, earning an 8 out of 10. The country's economy has not experienced steady growth since the 90s. The good news is that it's not regressing, so it gets a 2 out of 10 for growth. Stability and confidence are very strong. It's a stable, democratic, and diversified nation with a strong currency and good international relations, earning a 9 out of 10. Lastly, the industry, what can we say? Japan manufactures everything from top-notch cars to some of the most valuable media franchises in the world. In total, Japan gets an average score of 7.6 out of 10, placing it in the second spot on the National Economic Scoreboard. Well done, Japan. Thanks for watching, guys. I hope you enjoyed the video. Please leave a comment. Also, please consider liking and subscribing. I would really appreciate it. Thanks.